so really you can't time the market. And even if you could time the market, there may not be a downturn or a big downturn. There's certainly going to be some kind of softening, but it may not be like 08, 09.
Mhm.
So our thesis really is there's not a good time to buy or a bad time to buy. There are just good deals and there are bad deals. Good deals have downside protection, reasonable, achievable underwriting assumptions, reasonable, achievable upside, and bad deals are stretched. Bad deals are, if we do everything perfectly, we're going to make a 15 IRR. We don't want deals like that.
Yeah, exactly.
Yeah.
Way too optimistic, because we both know that the reality is never what we plan for. Sometimes better, sometimes worse. But if you stretch the numbers to make it work,
the spreadsheet will tell you. Yeah, the spreadsheet will tell you whatever you want it to. Right.
Yeah.
And one consistent theme across all of our models and all of our deals is our underwriting assumptions are always wrong.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec. And yet today we're interviewing a wonderful guest, Jacob from Denver, Colorado. Hi, Jacob. How are you doing?
Good to be on with you guys today. Thanks for having us.
All right. Well, look, I look forward to jumping into it. And before I introduce you, I just want to remind everyone, thank you for listening to the show. Please share this conversation with a friend who could benefit from this conversation, especially this episode. Jacob has a lot to share about his experience, about real estate investing. So it's packed of gems. So before we jump on, so I just want to introduce Jacob, who's a co-founder and partner at VanWest Partners, as you can see written behind him. It's a Denver-based real estate investment firm focused on the acquisition and management of self-storage centers, which is really exciting. We'll talk about that. And you guys also do some other opportunistic deals in the United States. I guess that means whenever there's a good opportunity, you guys jump on it. And you guys have established your success based on your commitment to delivering a perfectly executed, adaptable strategy with an institutional investment approach. So, Jacob, welcome to the show.
Glad to be here.
So you guys now have about over $250 million worth of acquisition. Now, Jacob and VanWest wasn't born with this, so you must have started somewhere. So Jacob, like, how in the world did you get started in real estate investing?
Yeah, I was in my early 20s, and I was a career firefighter, and I had a lot of time on my hands. You only work 10 days a month. So myself and a buddy of mine started dabbling in single family, doing some rentals, doing some fix and flips. And we got busy with that, and I quit my full-time job, and I've been, I guess, unemployed ever since 2006. And the first years of our careers, we focused on single family residential. We did a bunch of deals all over the country, mainly in the Denver metro area, but we covered a bunch of markets. Then we got into commercial real estate back in 2014 with some adaptive reuse retail projects around town. So basically converting old buildings around Denver into multi-tenant experience-based retail concepts like breweries, restaurants, yoga studios. Did some townhome development along the way, some multifamily. Covered a lot of bases in real estate, and we had looked at self-storage as an asset class for a while, and we liked the fact that it's been historically downside protected, recession resistant, durable recurring revenue streams. So we did our first deal in 2015, and that was a development project here in Denver. And at the time, our intention wasn't to, for the most part, transition to a self-storage owner-operator. It was more just, let's try a deal and see how it goes.
Yeah.
So we did a programmatic JV with some high net worth guys here in Denver and some institutional capital. Did a number of deals, and they reached their capital allocation in the space. We wanted to keep going. So we started doing our own syndications. We did our first fund in 19. Our second fund was in 21, and we're currently on our third fund. So it was kind of a organic evolution over time from fix and flips to lots of self-storage facilities.
Yeah, and it's a really good I was going to say experience, as you said, like starting with a friend in single family. Were those some flips? Was this some long-term hold? Or like, what was your idea at the time with those single family units?
Yeah, unfortunately, they were mostly flips. We have a handful of rentals that we kind of kept from back in those days, and had we had the foresight and the discipline to hang on
Yeah.
versus constantly trading, we'd have a much different asset base and I assume much more recurring revenue than we currently have. But who knew how good the market would get? As you probably remember, back in 08 and 09, it was pretty terrifying. So you wanted to get in and out of deals as fast as you possibly could.
Mm-hmm.
And we look back at what we sold some of those deals for, fixed up, and that price is a fraction of what those deals would trade for today, not fixed up.
Yeah.
Who knew the market would do what it did?
Yeah, but you had different needs, and you also have a family to feed, and you have some recurring expenses, and so you do need to generate
Sure.
some revenue now. And that's kind of a trade-off that most real estate investors have to figure out: is how much do I cash out now because I have bills to pay, and how much do I keep in equity and keep rolling forward into the future?
Yeah.
So you also mentioned that then you guys went to some repositioning some commercial properties to experience-based. So what was that like, and what got you into this?
It was those have been some of the most fun deals that we've done, and we still own a handful of those. We've sold most of those deals, but we'd find underutilized 100-year-old kind of brick warehouses, and we put a lot of money into them. We demise them, new grease traps, new plumbing, new electrical, new roofing systems, storefront, and we lease them up to retail tenants. The business was good. It's very construction management intensive.
Mm-hmm.
You're not building something new. You're trying to preserve some of the historic aspect of the building, but also kind of bring it up to code and make it look nice and give it another 100 years of life. And retail, especially kind of mom and pop retail, has more of an element of risk. I mean, we're not leasing these things to Starbucks.
No.
We're leasing these things to startup breweries and maybe second location restaurants. So you've got some risk profile in the tenant's ability to pay rent and kind of their longevity. But the biggest issue we had with it in general was it's really tough to scale.
Mm-hmm.
And bigger is not always better, but you can't go out one year and do 2 of these and the next year go out and do 10.
Yeah.
It just doesn't scale like that.
No.
So we found self-storage would kind of fit that criteria.
And as you said, this type of project is a lot more labor intensive in terms of project management, having a good contractor. And there's so much more unknowns because, as you said, you take a 100-year-old warehouse and you unpack it, and all of a sudden, well, the windows and the plumbing need a lot more love than you originally anticipated. So as you said, there's a fair amount of risk into this. As much as I'm sure the finished product looks great, there is a lot of uncertainty, and that doesn't always fit everybody's risk profile.
Certainly, but they're a lot of fun though, for sure. A lot of fun.
So then after that, you evolved directly to self-storage, or was there a transition? You said also a little bit of multifamily in between.
Yeah, we did some multifamily value add deals here in Denver. We did actually quite a few in Detroit that we just kind of got in and got out of back when the market was terrible. And like a lot of things, we should have held on to those. But we didn't really stop doing our other lines of business, then start storage. It was all kind of blended together. We didn't really wind down our single family program until about early 2020.
Okay.
And we're doing storage for 5 years, and we still had our single family acquisitions and operations and construction management team. But we were finding that deal flow was going down, and we were sourcing almost everything off market with direct to seller marketing. And we were spending a lot of money every month and getting fewer deals. Mm-hmm. So we finally decided to, my partners say, shut it down. I say pause, because I love that business and I miss it. Maybe we'll get back into it someday. But in the last 8 or so years, we've kind of developed a brand and a following around self-storage, being an owner operator. Yeah. So for the foreseeable future, that'll continue to be our main line of business until the opportunity shifts again.
And to find those opportunities in self-storage, did you do also direct mailing to mom and pop operators, or how did you structure it to have a good deal flow?
We did a fair amount. We did a fair amount of direct mail. It was basically a business letter saying that, hey, we're an owner operator. We're not brokers. We'd love a chance to underwrite your property. Maybe we could pay you a price that's attractive. And we probably placed, this sounds like a lot of money to you and I, but relative to our portfolio, wasn't that much. We probably deployed about, I don't know, 18 or 20 million, somewhere in there, off direct mail between 3 deals. We still do that kind of in fits and starts, but most of our deal flow the last few years has come from long-standing broker relationships that we've built. So they'll give us a call when they've got a deal that's coming up, and they'll give us pricing guidance. If we can hit that, we proceed with the transaction, and the broker will keep bringing us deals because we close. We do what we say we're going to do. If it's a widely marketed deal by a national brokerage outfit, we can almost never compete. We'll throw our hat in the ring, but we'll miss pricing by millions of dollars, even in this environment. And I'm sure we'll cover that in a moment. But yeah, deal flow is very competitive and inventory is low. So if it's marketed, we probably can't compete.
And so now there's been an evolution in the market compared to when you started into the self-storage. Now there's fewer deals. How are you finding them? And on the underwriting, is it still as attractive?
Yeah, well, we'll touch on kind of what the market's done for a moment. The pandemic years created an unprecedented amount of consumer demand. We all saw record NOI growth, occupancy growth, revenue growth. A lot of people were clearing out that extra bedroom, making room for the home office, putting their stuff in storage. And what we're seeing the last couple quarters is a return to kind of normalcy and a return to seasonality. Typically, the summer months are higher demand, the winter months are lower, and that kind of went out the window during COVID, but we're seeing that sort of come back. So nationally in the States, year over year, self-storage rents are down about 10%. And that's a broad stroke and a broad statement. So they're down
compared
10%.
To when? Compared
to a year ago, compared to, I think, June to June. Yeah. And physical occupancies on the REITs, which are the large real estate investment trusts that own storage, their occupancies have dropped from about 96% to around 92%.
Okay.
So it's down, but you have to give it context and what it's down from. It's down from an insane, never before seen peak.
Yeah.
So we're looking at it as kind of a moderation and sort of a return to normalcy. That being said, though, transaction volume has plummeted because buyers can't pay the prices that sellers want. And really the only sellers that are selling are folks that have a problem, a debt problem, they have a partnership problem, deal problem, or people who have kind of seen their facilities reach their life cycle and their plan originally was to sell around right now. So there's a lot lower amount of inventory than there used to be, but cap rates have not increased much. So if you look at cap rates, which is basically the way that real estate values are calculated, net operating income divided by cost basis, you can't pay a 5% cap rate on a stabilized asset and finance it at 7, right? The math doesn't make sense. So what has to happen eventually? Well, either values have to go down further or interest rates have to come back down. And I think a combination of those two things will happen eventually. But as of right now, pricing is still high, inventory is low, and transaction volume as a result has come way down.
Yeah. And seller expectation hasn't normalized. They still think it's like the heat of the pandemic and they expect to get the big bucks for their properties, but they forget that rates have tripled since years ago.
A lot of sellers got a valuation a year or two ago and they're kind of hanging their hat on that valuation and they want that same price today. And it might be worth that, it might not be, but buyers are saying, dude, I can't pay you that price anymore because I'm gonna borrow this at sorry about that.
No problem.
I'm going to borrow at a 7, and I can't pay you that same price anymore.
No.
So it's a unique environment for sure.
Yeah. So I want to dive a little bit more into the self-storage, like as a particular asset class. It's been a few years now that there's a lot more talk about it. It's still considered a niche, but why do you think that asset class in particular is so attractive for investors like you guys?
I think it's really because of a couple different reasons. I touched on this a moment ago, but historically it's downside protected. It's resilient during an economic disruption event. And the reason it is because people start moving up and down the economic ladder more frequently. They're losing jobs, they're getting a divorce, they're downsizing their homes. There's a need for storage. But it also performs well in good times. In good times, people are buying lots of stuff. They've got some discretionary income and they need a place to keep it. I'm not sure about Canadians, but Americans have a predisposition towards collecting a lot of things. They don't want to get rid of it, and they'll spend $2,000 a year to store $1,000 worth of stuff. That's just for whatever reason how we roll. So it's pretty downside protected. And another reason we like it too, even maybe more so than that downside protection, they kind of go hand in hand. We like the granularity of the revenue streams. So we have 18,000 units. And we're relying on our customers to pay us between $50 to $300 a month, and they're all month-to-month leases. So we're not beholden to one large tenant that makes most of our top line revenue. So, for example, we have a building in Denver. We have a brewery tenant in there. and they're paying us about $40,000 a month between base rent and CAM. That's a big number.
Yeah.
If we lose that tenant for whatever reason, it's going to cost us a lot of money to find a new one. It's going to take a lot of time.
Yeah.
If we lose a self-storage tenant, we just overlock their unit, we broom clean it, and we put a new tenant in there that's hopefully going to pay. So the revenue streams are very granular, and that's a good downside protection because we're not relying on one big group to pay us rent, but it also allows us to respond real time to supply and demand changes at the unit level and the facility level. So if we have a unit type that's really full, we can raise rents on those unit types by maybe 10% and probably not get many move outs. Yeah. And likewise, if we have a unit type, maybe a 5x5 that's lower on occupancy, we can drop rents below market and fill those up and then start raising rents over time. So there's a lot of levers that we can kind of pull real time to drive that revenue stream and drive NOI.
And for 18,000 units, I'm sure you're able to operate this with very few people. You have a small team versus the number of units that you have. I'm just thinking comparing to multifamily, where it's a lot less labor intensive for the amount of revenue you generate per square foot.
Yeah, we've got about 90 employees, and roughly 15 of those are in our Denver office, and the balance is our on-site field personnel around the country. But as a ratio to the number of units, that's pretty low compared to multifamily. And don't get me wrong, multifamily is a great asset class. There's going to be always a need for workforce housing, especially as the affordability gap and the wealth gap kind of increases. A lot of people who might have been homeowners a few years ago are going to be renters for a long time because they can't afford to pay the price right now, and their interest rates have doubled. So another kind of more specific example of multifamily versus storage. If you have a 500 unit apartment building, you've got 500 kitchens, 500 sets of appliances, maybe 1,000 bathrooms, right? Or 750 bathrooms, depending on the unit mix. In storage, if you have 500 units, you've got one bathroom, one leasing office, and maybe a break room if you even have one. So the maintenance is a lot lower. Don't get me wrong, though. The business is still very operationally intensive. We have theft issues. We have break-ins. We have gate systems going down, natural disasters, fires, floods, customers who don't pay, people who sleep in units, which is, believe it or not, a big problem. I'm not sure if you guys have much of that up in Canada, but down here we certainly do.
Tell me more.
So it's still,
what do you mean?
A homeless guy will rent a unit and he'll try to sleep in there overnight. So sometimes we become a multifamily operator when we don't intend to be, because people are sleeping in our units. So it has its fair share of operational challenges, but overall, it doesn't take nearly as many employees to run a large storage portfolio as it might a large residential portfolio.
No, for sure. And when you underwrite properties like that, what are some of the factors that determine good locations?
Well, we'll start with kind of the self-storage factors, but the rest of them are kind of just normal real estate data points. But the first thing we look at are supply ratios in the submarket. So self-storage is very local supply sensitive. So we'll track supply ratios in the 1, 3, and 5 mile trade radius. Nationally, there's about 8 square feet per capita of storage in the US. And some markets can sustain higher supply ratios than 8, some can't. It's all kind of a function of rents. So we'll look at the supply and just ask ourselves, is this supply ratio kind of balanced given the market conditions? If you have a new competitor come in and build a new facility, it's oversupplied, you'll see a decline in occupancies and rents. So supply ratios are the first thing we look at. In addition to that, which is equally as important, we look at obviously market rents. So what are 10 by 10s leasing for? What's a 10 by 10 climate controlled leasing for versus a non-climate controlled unit? And we determine whether the deal we're buying, if it's a value add existing acquisition, does that deal have a revenue stream in place that's below market? Is there an opportunity to come in and leverage our management platform, grow NOI by running the property more effectively? A lot of the sellers we buy from are not primarily self-storage owner operators. They kind of fell into the business. It's a side hustle. They built the facility 20 years ago, and they don't run them very efficiently. They don't raise rents. They don't control operating expenses. And in many cases, they don't even have a website. So we'll kind of leverage our platform to rebrand the facility and just operate it more efficiently. But yeah, supply ratios, rents, and then beyond that, just good real estate fundamentals. We want submarkets with population growth, low unemployment, disposable income. We have a pretty diverse geographic portfolio. We've got deals all over the Midwest, Southeast, Southwest, Mountain West. But we're very submarket focused, and we're less kind of macro market focused. For example, you might hear Illinois is not a great state to invest in real estate, high taxes, political challenges. But we own 4 deals in Illinois and they're killing it. And they're in good submarkets with low supply ratios and good demographics. So we're
Okay.
very local market focused and less so macro.
And it seems like there's a big industry on self-storage. So therefore, there is a lot of data available, and that's very useful to you to be able to compare location to location and assess the potential in each property. In the US, and just educate us about this. What is the big, I was going to say, governing institution that compiles data that's open to the public for people who are interested in assessing deals?
Yeah, there's access to data is decent, but it's not like it is in multifamily. You still have to kind of dig to get some of the data points you want to get.
Okay.
We use a couple different sources. One we use is called Radius, and that's a third-party software service that we pay for, and that'll give us all kinds of different data points. We also built our own software program. One of my partners is a software developer by training, and he built some software that basically scrapes all of the asking rates from thousands of facilities around the country every day, and it'll cache that data away, and we can look at historic rates based on like seasonality, new competition. So, for example, if a hurricane comes through Florida, you can look at a spike in rates because everyone's trying to fix their houses, they're taking care of flood issues, and they're putting their stuff in storage. So you see rates go up for 6 months, and then after that hurricane, kind of the damage sort of stabilizes and all the work's complete. You'll see rates kind of normalize back down.
Okay.
So, but asking rates is a very different metric than achieved rates. So somebody might be asking for $100 a month on their website, but if you walk in, they'll lease you that unit for $80 or more, maybe they lease it for 120.
Yeah.
So there's a lot of phone calls and kind of manual due diligence that we do on anything we're going to buy. We do diligence on our computer with our software, but we also actually go to competing operators and competing sites and in a veiled way, try to ask them, how's your occupancy? How's your net rental activity? And you don't want to give away who you are, but you push as much as you can to get all the info you can.
Of course, as a prospective client. And then kind of lastly, so you've been able to grow the company organically. Can you share a little bit with us about your investors? Like how did it work? I mean, to acquire 250 million of assets, you obviously had to open up to partnerships. What's roughly your structure?
Yeah, we as I mentioned, we're on our third fund right now, and we raise capital. I mean, we have a very diverse investor base. We have some ultra high net worth investors, and we have just active income professionals. Maybe they have a law practice, or they're engineers, or they're in the dental practice business, and they have a lot of active income and they want to diversify into real estate. So we raise capital from private investors. Our current AUM is actually, we got to update our one pager. It's closer to 300 million. And our average capital account size is probably 250K across all of our investors. So we have folks who come in for 50,000. We have folks who come in for 5 million, just kind of a wide range of avatars there. But our structure is fairly simple. We have an 8% preferred return, then capital's return, and then it's an 80-20 split in their favor.
Nice. Yeah, it is very, very attractive.
Yeah, the days of, I think there's a lot more sponsors needing capital than there used to be. And I think 2 years ago, the LPs were needing to place their capital and the sponsors had money just raining down on them because the environment was so different. Yeah. And now that's shifted a lot. So if you don't have a fair split, or what's viewed as a fair split, you're going to be having challenges raising capital. So you got to give your LPs most of the upside. Otherwise, they can find something else.
Exactly. Opportunity cost of money. Wonderful. And then if anyone wants to find out more about you and the company, VanWest, what's the best way to get in touch?
Well, yeah, we always love talking shop about real estate. Folks can email me, jacob@vanwestpartners.com. They can go to our website, vanwestpartners.com, or they can hit me on LinkedIn, Jacob Vanderslice.
All right. And then lastly, I'm just thinking, like, if anyone is listening to this, or even myself, what can we do to help you?
What can you do to help me? You can bring us deals. If you know a person who's trying to sell a storage facility, let us know. We can pay you a commission or a fee or a finder's fee. But deal flow is very challenging right now, and we're always looking for good investment opportunities.
Perfect. Well, so you hear this. If you're listening to this right now and you know of a facility in the US, contact Jacob. It may just lead to a transaction. Otherwise, it'll just be a nice, friendly conversation. And in any case, you can learn from it. So get into the action and offer some properties. Jacob, it's been a real pleasure to have you on today. Thank you very much for your participation.
Great to meet you, and enjoy the rest of your summer up there.
Sounds good. And to everyone listening, again, share this conversation with a friend, take action, research your market, and make some offers. I'll talk to you next week. Thank you very much for joining today. Bye-bye.